Hi, this is Jerry Bowyer for the Eagle Investing Network. Make sure to hit subscribe to our YouTube channel and share this with other people who you think might want to have a better understanding of economics, finance, and investing. Well, welcome to what so far is the half recession of 2022. Well, what do I mean a half recession? Well, first, let's answer the question, what is a recession? A recession, according to one of the dictionary definitions, is 2 or more consecutive quarters of negative GDP growth. Well, what is GDP? GDP is probably the most popular measurement of economic outcomes, the most popular measure of the size of the economy. Now, it's actually not the best measure. I'm going to tell you about another one in a future video called gross output, which actually looks at the entire economy. But GDP is the famous one, and it's the one they talk about in the news the most. And it's basically an attempt to measure the output of the economy. What is the American economy producing in any given year? Really more, what are people purchasing? It's a measure of spending. Well, normally in America, because this is America, we're a growing economy. Normally each quarter, that number is bigger than the quarter before. But once in a while, it gets smaller. Once in a while, this measure of the economy shrinks, which means that that's negative growth. According to one of the definitions of a recession, if you have that happen 2 quarters in a row, a quarter is a 3-month period. So if you have a 3-month period where that goes down, and in the next 3-month period that goes down, that's 6 months where it went down, that's a recession. Now, there's another definition that people use a lot in the news, which is that the National Bureau of Economic Research declares a recession. Well, that's a group of economists who have their opinion. They're as influenced by politics and career and alliances as anybody else. So there's nothing official about it. I'm just going to go with the simpler definition, which is 2 quarters in a row of negative GDP. Well, we just found out that the first quarter of 2022 was negative. So that's 1 quarter so far of negative GDP. Let's take a look at the data and get a better sense of what's going on. So this is GDP. This is real GDP. So we're accounting for inflation. Like if the output of goods and services goes up in a quarter, but that's just price increases, we're not going to call that growth. That's just higher prices. So this accounts for that. So let's see. This is since 2011. We're going to see what's happened. So whenever it's above the line, you see there in 2014, there was 1 quarter of negative growth, and there was actually one in 2011, 2012. So once in a while, we'll have a negative quarter of growth. And then, of course, we have that here, and we have that here. That was an economic slowdown. That was a problem. But then we kind of went back to normal growth. And then we have COVID, incredible contraction of the economy, more than 30% contraction on an annual basis. And then we bounce back very strongly. And why does that happen? Well, partly because deferred economic activity that didn't take place here, it takes place here. People put things off for a quarter. You're not allowed to go to the mall, but now you are allowed to go to the mall. You're not allowed to go to the theater. Now you are allowed to go to the theater. So that's part of what's going on. Now, in a moment, we're going to take a look at some data that helps us not be fooled by some of this. I want to talk to you about something called baseline effect. There's a little math. Don't worry, you can handle it, but it's just a little bit of math. So I want you to imagine that something that is $100 goes down 50% to $50. All right, so it went down 50% and now it's $50. If it goes up 50%, it's $75. Because you've got 50% of that lower number, that 50. So you're not all the way back up to 100, you're just back to 75. That's called a baseline effect. So this looks like we went down 30% and we went up 30%, so we're back to where we were. No, that's not how it works. You have to look at the actual dollar changes in order to see what's really going on. And we're going to come back to that in a moment. So because the economy contracted so much, that distortion makes a lot of this look better than it really is. And then what we see is we have a lot of economic growth. And then what happens is eventually those baseline effects disappear and we no longer are bouncing off of this crater of economic destruction. And we actually have to earn our growth. It's not just showing up with a kind of a math effect. And what we've seen is that slowed down. And then in the first quarter, it was actually negative. That's what I'm calling the half recession. Okay, so I want to talk to you about this a little bit. I'm going to go over this baseline effect thing again. What we're really trying to get at is how big is the economy? And is it getting bigger or is it getting smaller, and at what rate? So in order to do that, we're going to look at GDP differently than most of the news coverage. We're not going to just look at the percentage change. We're going to look at the actual dollar change. So let's take a look at the data on that. And this is dollar change in GDP. Let's get it rolling. So we're just going back a few years because we're just trying to get a look at the recent situation. So this, well, and there you see, there's the terrible destruction of COVID. And if you look, everything under this line is negative. So this is really a depression, even more than a recession, but a short and sharp one. And as you see, the volume here is bigger than the volume here. So at this point, we haven't made up for that, right? It's really more around here that we've made up for it when you're actually looking at the dollar change. And what that means is the easy growth number. The idea that it's easy to get high growth numbers because you're coming off of that low baseline, that goes away. And now we're looking at what actually is going on with the economic outlook. And what does that happen? Not very strong in Q3, pretty good in Q4, and then by the way, that's economic talk. Q4 is the fourth quarter. In this case of last year. Q1 is the first quarter of this year, 2022, and we see that that went down 1.4%, and we see that going on here. So we're into a kind of a new normal here. We're into a situation where economic growth is likely to be very low, maybe even negative. If we get another quarter, that would be a bona fide recession. But you know what? It can be bad news even if we just skirt along at 1% or 1.5% or 2% growth for a while. Arguably, a longer period of stagnation is worse than a short recession. Recession of half a year or 3/4 of a year, and then you come out of that strong, that can actually be good for an economy. But years and years of stagnation, especially with inflation, amounts to a very painful economy. And yes, we do have inflation as well, and we're going to deal with that in a future video. So this is the half recession. This is where we are so far. And, it'll take another few months before we know what the second quarter did. But growth concerns are of a great concern. So we're going to come back and we're going to talk about a better way to measure the economy, which is gross output rather than GDP, which looks at the entire economy, including business. Because if you're an investor, you're not investing in the economy, you're investing in business. So we need to see what's happening in the business cycle. And we're also going to look at inflation because inflation is very important for investors, because inflation means that if you get positive return, you can still lose money if your positive return isn't higher than the inflation rate. So you have to not just beat zero, you have to beat the inflation rate, which is a real headwind for investors. I'm Jerry Bowyer. This is the Eagle Investing Network. Did you hit subscribe? If you didn't, do it now, and also share this video with someone else.